Eric, how are you today?
Dave, doing well. How are you?
Good. I'm doing well. We got on a little topical conversation that we don't talk a whole lot about, but something that we get questions on sometimes, and I think that a lot of people just don't really understand, and that is the topic of amortization.
So, we'd like to talk to you about some amortization hacks, but almost now some myths after we've talked about it a little bit, you and I. And we would like to present that amortization is the experience of your loan payments over time going from whatever balance you start with, getting down to zero at the end of the loan, right? So, on a 30-year fixed, how long does it take to pay off that loan, Dave?
I would say 30 years.
30 years. So on a 15-year fix, similarly, it's 15 years. And so the term of the loan describes over time what happens with the payments, the principal, the interest, the principal reduction over time. And what we're going to talk about a little bit is what do you do to hack that or pay it down more quickly? So, what we're going to talk about is the habit and the approach to be able to pay down your loan more quickly. But there's some caveats here we talked about once we started really looking into this. We've heard about things over the years, and there's other types of programs available. Dave, can you explain what's out there sometimes that people get attracted to with paying down their loan faster?
Yeah, so a couple things. So first off, you mentioned it a little bit ago, but the basics of amortization is what when I make a mortgage payment, for example, or a car payment each month, it's made up of two components. It's made up of principal and interest, right? So, and what happens is on a 30-year mortgage, by the way, which is 360 months, a lot of people when they first take out a 30-year mortgage, like, oh my gosh, I have to make 360 payments. Seems like a lot, which it is. But what's going to happen is that the part of your mortgage payment on a monthly basis at the beginning is going to be made up of more interest than it is principal. So you're going to pay down your principal balance not as quickly in the first few years of the mortgage. Then towards the end, it's going to switch over. Let's call it about the halfway point. You're going to start paying more principal each month than you are interest as the mortgage progresses throughout its 30 years. So anyway, a couple of things around amortization is if you took out a 30-year mortgage, Eric, versus a 15-year mortgage, which one is going to pay off faster?
So the 15 years a year is going to pay off faster.
Which one's going to be more expensive?
That is a question over time because you're going to pay more interest over time on the 30 year. You're going to pay more payment on the 15 year. But where does that extra payment go, Dave?
Good perspective, Eric. And I totally forgot I said, what's more expensive? And you're right. So over time, the 30-year is going to be more expensive because you're paying more interest. But on a monthly basis, from a cash flow basis, the 15-year is going to be more expensive. And one of the pitfalls that people get into, and I suggest sometimes, is people say, well, geez, I really want to do a 15-year loan because I want to pay my loan off sooner because I'm going to retire in 15 years or whatever the case is, and I don't want to have a mortgage, which is totally fine. Something to keep in mind, though, is that if you take out a 15-year mortgage versus a 30-year, you are obligated to make a 15-year payment. If for some reason you had an unforeseen circumstance and you lost your job or some medical expenses or some other thing came up that you needed the cash for and you couldn't afford to make that 15-year monthly payment, that would be tough. But even on a 30-year mortgage, you can always pay it off in 15 years if you want to. You would just have to calculate out what that payment would be in order to pay the loan off in 15 versus 30 years.
That's right. So any fixed period loan can get paid off sooner, and we can easily calculate via amortization schedules what that payment would need to be to pay it off in 22 years and 18 years and the 15-year option for comparing it to a 15-year fixed. Oftentimes, if it's a question, we like talking about the 30-year fixed and then telling you what the payment would be if you wanted to pay it off in 15 years.
And there's a benefit too on the 15-year loans because typically the interest rate might be a little bit less. I think the example we're going to go through is like a 0.25% less. Again, based on today, those can change from day to day. You also see lenders offering a 20 or 25-year option as well. And same thing, the shorter that term, the faster you're going to pay it off, the less interest you're going to pay over time. However, again, that's going to have an impact on your mortgage payment because the shorter the term, the higher the payment based on the same principal balance.
So let's talk a little bit about the hacks. I'm going to go ahead and share my screen, and I'm going to do that right here via. So Dave, here is the shared screen, and what we did here is we used Excel simply to create ourselves a calculation table over here. We'll get to what that means, and then just a graphical showing what happens to a principal balance over time, given 3 examples of payment methods. So we start off with a 30-year fixed. I know that might be kind of small for folks, but a 30-year fixed, the standard payment, a 30-year fixed, making essentially an extra payment a year. We'll get to how we got to that. And then a 15-year fixed payment, which again would be a standard payment on a 15-year fixed amortization. So with that, the loan balance, an example, is $500,000. The interest rate, we're just picking one out of kind of the general range today, 7% on the 30-year fixed as an example, and showing a correspondingly better, slightly better interest rate of 6 3/4 on a 15-year fixed. And these would be what the minimum due payments then would be on those 2 types of amortization plans. So on a slightly higher rate, but 30-year term, this example on a $500,000 30-year fixed interest rate payment would be a $3,326.51, opposed to $4,424.55 for the same loan balance, but paid over just a 15-year period of time. So you can see that difference in payment, mandatory if you pick the 15-year over the 30, is basically about $1,100 difference a month that you would pay towards the payment, which would translate to a much quicker pay down in paying more principal per payment than if you were on a 30-year fixed.
Perfect.
So I know that was a lot. I also want to explain and give it back to you in just a second. What we did is we want to show side by side. Let's just say you made that extra payment per year. So a lot of the payment plans you were talking about before this call and introduced in this call, where you take one extra payment, so that's applied differently sometimes. We just took literally one extra payment and divided it by 12. This is what that would look like if you added it to each payment. It would push this 30-year fixed up to $3,600 a month basically, and pay it down a little more quickly. We show that side by side. I'll pass it back to you.
No, that's great. And basically that middle column there, the extra payment. So you see this advertised quite a bit. I'm sure if you've talked to your lender about the possibility of doing a biweekly mortgage, equity saver, equity advantage, you hear them under numerous different names. And basically what that is that typically what a lender would do is refer you to an outside third-party company that would set up basically an account for you where they would collect basically half of your payment every other week instead of once a month. And what that does is that you end up making 26 half payments a year instead of 24, and you apply one full principal payment towards your mortgage on an annual basis. It's good for some people. It's not good for everybody. Some of the pitfalls are obviously when they're taking money out of your account on the 15th of the month to make your payment on the 1st of the following month, then you're foregoing the interest you would have earned on that second half of the month. So sometimes they can keep that money for 30 days, for example, and the company is the one earning the interest on that money versus yourself. But there's also some advantages, and I've used this program before personally, in that it was better aligned for me, where if you get paid biweekly and you can line up your withdrawals on the same days you get paid, so you get paid 26 times a year, great, that's perfect, because then you're making, a payment on the same day you're getting paid, but it's a half payment, right? So it's a little less to bear on the 1st of the month when you have a larger mortgage payment, for example. But again, there's other ways to do it other than having to go through a third-party company. You can actually do this on your own. And Eric, why don't you explain kind of how that works?
Yeah, and I'd also like to add to what you just said. Your servicer, the lender or the holder of the note that you pay money to every month as a mortgage borrower, will not be able to take half payments on behalf of you directly towards your account. So that's where the intermediary helps. by collecting those payments, making the regular payment, and then saving up and making an extra payment. So there is some benefit to that option versus you doing it yourself, because you can't actually physically make the half payments. You have to make full payments, or full payments with extra payments over time as well. So getting to this, the example here is that we show each loan option starting out as a $500,000 balance, which makes sense. That's how much we borrowed. And then they're paid back over time against these different schedules. So one example is this base 30-year fixed $3,326 payment. The next example is adding $277 to that payment to make it $3,603 right in this column. And then this column represents what would happen if you made the 15-year fixed payments. And we show the corresponding balances of your loan over the year 1, 2, 3, 4, 5 here. And we also show it at year 10, just to give an example that if you stayed in that same loan for that amount of time, what would happen is the difference would start to spread. So the benefit of amortization and the benefit of time value money is that the faster pay down of the 15-year fix is starting to pull away from the pack. The extra payment 30-year fix is starting to pull away a little bit more from the 30-year fix, just standard payment. What's interesting though is as we went through this math, we had to account for what's the extra payment you're really making, right? So you can't just say, well, I have extra equity in the 15-year fix, but you also paid about $1,100 more a month over the 5 years or over the 10 years to get to that extra equity as well. So what's the difference between what you actually paid and the extra position in equity versus if you just set the money aside and let that sit and do something else? And we don't even factor a rate of growth for that money that you set aside here. So you're not talking as big of a difference here as you may have thought. Now, again, someone's financial strategy may be, I'm just better set and forget, and this will happen for me. Or I have a time horizon where I want to retire or I want to move or whatever. Let's just say at 15 years. So having a 30-year fix doesn't really fit that need because you'll still have a balance and a payment after the 15 years. So there's a lot to go into this conversation, but kind of the hack is that there isn't any magical fairy dust to make your payment go, up or spread out the amortization differently over time. This all has to just simply work dollars and cents. And as it trickles down, there are benefits for going with a shorter term, but you actually pay for that benefit. So the realized benefit is a little less than people advertise sometimes.
Yeah, absolutely. And, again, there's a lot of different options here. And one of the things that we had talked about, Eric, was, what happens here. So again, the equity from the amortization that you show in the middle column there, the 49,188, that's great. But at the end of year 5, you've got that $49,000 in equity, but it is locked into the house. And the difference there is the difference between the 29,000 and the 49,000. So call it $20,000. Whereas if you would have put that $277 into an investment account, a money market account, I don't want to give investment advice, but wherever you chose as a vehicle to put that money into, maybe you want to do a 529 plan for a child that's going to college in a few years, or whatever the case was. That money would grow by itself within that investment account. So at the end of that 5-year period, rather than that money being locked up into the property and having to do a home equity loan or do a refinance in order to get access to it, you would have that available to you in that investment account for whatever that need was that arose at year 5.
So you're bringing up a fantastic point in that a fixed term and fixed rate product is not a home equity line. You can't just pay into it and then pull it back out. So if you commit to the more advanced payment, the higher payment per month to take advantage of that amortization, you don't have access to that money anymore. And it doesn't reduce your minimum due. So one thing we were going to talk about and make sure we touch on is that if you pay, so Dave, let's just say this $500,000 loan, this $500,000 loan we start off with, year 2, you sell a car or you sell an investment and you have $50,000 more you want to throw into the mortgage and pay it down. What happens to your minimum monthly payment on a fixed rate loan?
Absolutely nothing. So it stays the same unless you can get your servicer or your investor to recast the loan for you. And some servicers will do that and some won't. But typically what would happen is they would take whatever that. So in this example, Eric, let's say you take $100,000, you sold another property, you got an inheritance, whatever the case was, and you wanted to pay down your principal balance from let's call it the end of year 5 there in the left column is $470,000. And so now your principal balance remaining is 370,000. So like you mentioned, even though you've put $100,000 down, it's not changing your monthly payment because it hasn't reamortized. It would certainly shorten the time it would to pay off the loan because you have an extra $100,000 in equity, but it would not change your payment. But what you could do is, if the lender was willing, is to recast the loan over the remaining term of the loan at that new lower amount. And that, in fact, would lower your monthly payment, but only if you could get the servicer to actually recast your loan.
So by throwing a large principal balance down, you can either shorten the duration of the whole loan period by changing the amortization of each payment, or in the case of the recast, if your servicer allows you to, you probably want to check with them before you invest the money in. It can lower the balance, but keep the term still the same as the remaining periods of months due. So that would recast and lower the monthly payment, but keep the duration of time the same.
Or you could take that $100,000 and call your friendly mortgage advisor and see what you could do to go out and buy an investment property, a second home, or some other real estate asset that you might want to do instead of dumping that money into your primary residence.
So that's something that we were talking about specifically right before recording this call, is that there is opportunity cost and there's leverage here where if you set money into your mortgage, you don't necessarily gain a lot of leverage. Your home's value is going to be the same value no matter what your mortgage balance is beneath it, right? So if you pay more equity in, your house value is still the same. Your spread on equity might grow a little bit, but if you did something else with that money, created some more leverage with more real estate, or invested it into some other investment vehicle, or did both, you've created maybe more leverage, but your asset value of your house is still worth the same either way.
Which is a really great reason of why you'd want to work with a professional mortgage advisor that understands both your short and long-term goals. So they can help assist you with what to do best with your money and how much you should put down on this property versus, potentially going into some other investment as well.
And maybe a little side note, something I think you probably mentioned with your first-time buyers, I know I did with mine, is that you always want a little bit of a rainy day fund. So you don't want to just be hammering all of your cash into something like paying down your loan more quickly and not have anything left over for a rainy day fund, that side account that can be tapped into as things are needed over time.
Yeah, absolutely. I mean, especially because, we've both been first-time home buyers before. And I, bought a few houses, and it never fails that you buy a new house and there's always something that you need as much as you think you don't. It's like, oh boy, I forgot we need window coverings, or we need to do landscaping, or, it doesn't have a barbecue, or, all those things. So I definitely agree, not only to plan for what you might need to get the house the way you want it when you move in, but also in the event that something unforeseen happens that you just need a little cushion to fall back on. It's a great idea.
I love it. Well, Dave, thank you so much for this concept, because you actually came up with it. Appreciate it. I think it was a good discussion today. Hopefully people learned something.
Appreciate you, Eric, and hopefully we helped a few people out. Thanks so
Talk
much.
to you soon.